You've probably heard the number. The average Canadian retiree lives on about $33,000 a year. And maybe that's landed differently depending on where you are right now. Relieved because you think you can match it, or worried because you're not sure you can get there. But here's the thing. That number is both correct and completely misleading at the same time. Statistics Canada puts the median after tax individual income for seniors at $31,400. That's the real figure. But what that number doesn't tell you is how different two retirees with the same $33,000 can look financially. One person is drawing down savings every month, watching the balance shrink, and hoping it lasts. The other is a homeowner who keeps their taxable income below $22,512 and collects over $33,000 a year. Tax-free, without touching a cent of their RRSP or savings. Same number, completely different situation, and that gap comes down to one thing: which income streams count against your government benefits and which ones don't. Because CPP counts. RRSP withdrawals count, but TFSA withdrawals don't count, and the value of your paid-off home doesn't count either. If you're a Canadian homeowner over 55, and you want to retire on more than the average, or at least understand how the real numbers work before you make any decisions, stick with me. I'm going to show you exactly how the income stack breaks down, where the hidden bonus lives, and what one quiet strategy can do to change your retirement completely. Let's look at what retirees actually receive. In 2026, the average CPP retirement pension at age 65 is $925.35 a month. Full OAS for someone between 65 and 74 pays $743.05 a month. Add those together, and you're looking at $1,668.40 a month, about $20,021 a year. That's a real income. But most people stop right there and start filling the gap with RRSP withdrawals, and that's where the trap begins. If your total income, excluding OAS, stays below $22,512 a year, the government adds a third benefit called the Guaranteed Income Supplement, or GIS. For a single retiree in 2026, GIS pays up to $1,109.85 a month, and it's completely tax-free. So a single retiree with a paid-off home who qualifies for all three, average CPP, full OAS, and full GIS, can receive $2,778.25 a month. That's $33,339 a year, without touching savings. Now compare that to the Statistics Canada median of $31,400 for individual seniors. The GIS strategy doesn't just match the average, it beats it, and the income is cleaner because GIS isn't taxed. But here's where it gets uncomfortable, because most retirement advice points you in exactly the wrong direction. The standard guidance is, take CPP as early as you can and start drawing your RRSP to supplement your income. That sounds reasonable. The problem is that every dollar you pull from your RRSP or RRIF is taxable income, and it counts directly against your GIS eligibility. You can lose GIS dollar for dollar as your RRSP withdrawals climb. People end up withdrawing more from savings to replace the GIS they just eliminated, which depletes the account even faster. I used to think the average income figure was the benchmark everyone was working toward. But after looking at case after case, I realized the real number depends entirely on which accounts you draw from and in what order. Most people are drawing in the wrong sequence without realizing it. Here's a quick way to see the mechanic clearly. Say your only income is average CPP at $925.35 a month and full OAS at $743.05. That's $11,104 from CPP annually, plus $8,917 from OAS. CPP counts toward the GIS income test. OAS does not. So your countable income for GIS purposes is $11,104. That's well below $22,512. You qualify for full GIS. You're now at $33,339 a year with no RRSP involved at all. Now say you pull $15,000 from your RRSP on top of that. Your countable income jumps to $26,104. Above the GIS threshold, you lose most or all of your GIS. That $15,000 RRSP withdrawal didn't add $15,000 to your income. It replaced GIS you would have received anyway. You're working harder to stay even. The key isn't earning more from the government. It's keeping your taxable income low enough to protect the benefits you've already qualified for. This isn't gaming the system. It's understanding that GIS was designed for exactly this situation. Retirees who have assets but limited taxable income. Owning a paid-off home doesn't disqualify you. The home doesn't count, only income counts, so the real income floor isn't the average. It's the combination of CPP, OAS, and GIS, and whether your withdrawal strategy keeps you inside the threshold or knocks you out of it. So if the goal is to keep your taxable income below $22,512 while still paying your bills, the obvious question is, how do you actually live on that little while your savings sit untouched? That's where the strategy gets interesting, and it comes down to a simple distinction between what the government counts as income and what it doesn't. TFSA withdrawals are not income. They don't appear on your tax return. They don't affect your GIS eligibility. Neither does the value of your home. Whether it's worth $400,000 or $900,000, it doesn't count. So if most of your wealth is sitting in a paid-off house and a TFSA, you can draw on both of those without touching your official income number. The strategy works like this. You deliberately stay asset-rich but income-poor on paper. You let your CPP and OAS come in. You keep RRSP and RRIF withdrawals at zero or near zero in the early years of retirement, ideally before you're forced to take minimum RRIF withdrawals at 72, and you fill any spending gap using TFSA withdrawals or cash savings. That keeps your countable income low, GIS flows in every month tax-free, and your RRSP continues to grow inside the account untouched. Let me give you a concrete example. Take a couple, both 65, who own their home free and clear. Between them, they have $400,000 in combined RRSPs and $100,000 in TFSAs. If they each take their average CPP and start drawing $15,000 a year from the RRSP to supplement, their combined taxable income climbs well above the GIS thresholds. GIS disappears or shrinks significantly. But if instead they draw only from the TFSA, say $15,000 a year combined, and one of them defers CPP to age 70, their taxable income drops sharply. In the years before CPP starts, they might have only OAS coming in at $8,917 per person per year as countable income. That puts each of them well under the $22,512 single threshold, or under $29,760 for a couple. GIS flows in on top. They live on $37,000 or more a year, most of it tax-free, and the RRSP sits untouched growing for later. I remember one client, a retired teacher in Kingston. She had a paid-off house, $200,000 in her RRSP, and was genuinely frightened of outliving her money. She was pulling $2,000 a month from her RRSP because she thought that was what you were supposed to do. What she didn't realize was that those withdrawals were eating into her GIS dollar for dollar. She was losing roughly $1,000 a month in GIS she would have qualified for otherwise. We shifted her plan. She stopped RRSP withdrawals, started drawing from her TFSA instead, and deferred her CPP. Her net monthly income went up by about $800 almost immediately. The RRSP was still there. She hadn't spent it. She just stopped triggering the income test. There are two paths here, and they lead to very different places. The first path, draw RRSP early, push taxable income above the GIS threshold, lose the supplement, need to draw even more from savings to compensate, and deplete the account faster than expected. The second path, use TFSA-first, keep taxable income low, collect full GIS, let the RRSP grow, and withdraw from it only later when it may serve a different purpose, either as income when spending rises as a legacy, or as a buffer if one spouse dies. The fragility isn't in having less money. It's in drawing from the wrong account at the wrong time. And the long-term cost of the first path isn't just the GIS you lose each year. It's the compounding effect of depleting assets that would otherwise keep growing. Now, the strategy sounds close to perfect. And for many homeowners, it is the right framework. But there's one scenario it doesn't protect you from. And when it happens fast. I've watched a friend's mother lose 40% of her monthly income in the same month her husband passed. She didn't see it coming. Nobody had warned her. And sitting with her through that, not just the grief, but the sudden financial panic, is something I think about every time this topic comes up. I don't want that for you. Here's what actually happens to income when a spouse dies. Take the same couple we just described. They're both 65, using the asset-rich strategy well. They each receive OAS at $743.05, and as a couple, they qualify for a reduced GIS. The couple's rate is lower per person than the single rate, but together they're collecting meaningful income. Their combined monthly picture looks solid at roughly $2,800 or more, depending on CPP timing. Then one of them dies. The income doesn't just drop by half, it drops by more than half in many cases. The surviving spouse keeps her own OAS at $743.05. She now qualifies for the single GIS rate, up to $1,109.85, because she's no longer counted as part of a couple. If her husband had already started CPP, she may receive a CP survivor pension, which maxes out at $904.59 a month for someone over 65. So on paper, you could add $743.05 plus $1,109.85 plus up to $904.59 and get $2,757.49 a month. That seems close to what the couple had together. But here's where the real loss shows up. If the husband had been receiving his own CPP, that stops at death. The survivor benefit replaces part of it, not all of it. And if his CPP was above the maximum survivor rate, the income gap can be significant. Couples who were drawing two CPP amounts, say $1,500 combined, may lose $600 or more per month in CPP alone, even after the survivor benefit kicks in. Researchers and financial planners generally estimate that surviving spouses see an effective income drop of 30% to 50% once all adjustments settle, and the expenses don't drop proportionally. Property taxes stay the same. The hydro bill barely moves. Car insurance doesn't care. The fixed costs of running a home are mostly unchanged, but the income to cover them just fell by a third or more. Two moves can limit the damage significantly. The first is coordinating CPP start dates. If the higher earning spouse defers CPP to age 70, their eventual monthly benefit is 42% higher than it would have been at 65. When they die, the survivor pension is calculated from that larger base. The survivor ends up with a meaningfully larger benefit than if both spouses had taken CPP early. The second is a joint life annuity. For at least part of your savings, not all of it, a joint life annuity pays income to both spouses and continues to the survivor after one dies. It's not the most exciting product, but it solves a specific problem. It guarantees that a floor of income cannot be lost to a death event. The payout is lower than a single life annuity, but the floor holds. paying a little less income now in exchange for certainty that the floor doesn't collapse when one of you is gone. For a lot of couples, that's worth it. Here's the part that trips most people up. You can understand the strategy completely. Keep income low, use TFSA, defer CPP, protect GIS, and still find yourself resisting it. And the resistance isn't irrational. It comes from somewhere real. The number one reason Canadians take CPP at 60 or 65 instead of waiting until 70 is the fear of dying before they get their money's worth. If your father died at 68, or a close friend didn't make it to 70, that's not just a statistic. That's something you carry with you. Of course you're thinking about taking CPP early. Of course you want to lock in what you've earned while you're still here to use it. I used to think the same way. I thought deferring CPP was a gamble on your own survival, and I wasn't sure I wanted to make that bet. Then I looked at the actual numbers. For a 65-year-old man in Canada today, life expectancy is around 84 years. For a woman, it's closer to 87. The actuarial break even for deferring CPP from 65 to 70 is roughly age 82. That means if you live past 82, and statistically, the odds are better than 70%, you come out ahead by waiting. Every year after 82, the gap grows. By 87, the person who deferred has collected tens of thousands more in total CPP than the one who took it early. And if you die before 82, it's not like the deferred money vanishes. Your spouse receives a survivor benefit, calculated from your full deferred amount. The strategy still pays. The real risk isn't dying early and leaving money behind. The real risk is living to 90 with an income that runs out, or an income so low it makes every year feel tight. That's a much harder situation to be in than having deferred CPP and lived well past break even. This doesn't mean everyone should wait until 70. Health matters. Your specific CPP amount matters. Whether you have a spouse matters. But the fear of dying before break even shouldn't be the reason you take it early. That fear is almost always bigger than the actual probability. So if you want to put this into practice, here's how to actually start. Step 1. Get your CPP Statement of Contributions. You can request it through your My Service Canada account. It shows your estimated CPP benefit at age 60, 65, and 70. That number is the foundation of everything else. You can't plan around deferring CPP if you don't know what you're deferring. Step 2. Know your GIS income threshold. For a single retiree over 65, you need to keep your taxable income, not counting OAS, below $22,512 to qualify for full GIS. For a couple, that combined threshold is $29,760. These numbers are adjusted periodically, so check the current rates on canada.ca before you rely on them. Step 3. Prioritize TFSA withdrawals over RRSP and RRIF withdrawals in the early years of retirement, roughly ages 60 to 70, before RRIF minimums kick in. Every dollar you take from a TFSA instead of an RRSP is a dollar that doesn't count against your GIS eligibility. This is the most direct lever most people have. Step 4. Consider a joint life annuity for at least a portion of your savings. You don't need to annuitize everything, but converting part of the RRSP or RRIF into a guaranteed income that continues to your spouse can act as the floor that holds when the rest of your income structure shifts after a death. Step 5. If you have a spouse, coordinate your CPP start dates. Specifically, if one of you earned more over your working years, consider deferring that person's CPP to age 70. At 70, the monthly benefit is 42% higher than it would have been at 65. When that spouse dies, the survivor pension is calculated from that larger base, which means more income for whoever is left. Now, there's one more move that's worth knowing about, even though it's more complex and not right for everyone. If you're over 65 and your spouse is under 65, there's a mechanism called a spousal RRSP that allows you to contribute to your spouse's plan. Under certain conditions, This can shift income from the higher income spouse to the lower income spouse, reducing the higher earner's taxable income and potentially pushing it below the GIS threshold. The rules around this are specific, and the timing matters a great deal. This is one where you want to sit down with an accountant who knows RRSP and RRIF rules, not just general financial advice. But it's a legal and legitimate tool that many people don't know exists. If you want the full breakdown, how to run these numbers for your actual situation, with real CPP estimates and your account balances, I'll be releasing a video next week that walks through exactly that. The average retiree income of $31,400 is a benchmark, not a ceiling, and for homeowners, it doesn't tell the full story. By keeping your taxable income below the GIS threshold, drawing from your TFSA before touching your RRSP, and coordinating CPP timing with your spouse, you can land at $33,000 a year or more, largely tax-free, without depleting your savings in the first decade. The survivor cliff is real, but joint life annuities and deferred CPP can cut that income drop significantly, so the floor holds even after a death event. Retirement planning isn't really about earning more. It's about keeping more by understanding which doors the government opens for you, and making sure you walk through them in the right order. If this was useful, hit subscribe. My name is Brian, and this is your Canadian Retirement Playbook. I'll see you in the next video.